Walk into almost any finance class in the world, and you will be taught a basic equation. If you want high returns, you have to take on high risks. The system insists that to make serious money, you must expose yourself to serious potential losses. But the most successful investors in history operate on the exact opposite principle. Warren Buffett famously states that the first rule of investing is don't lose money, and the second rule is to never forget the first. They achieve extraordinary returns precisely by avoiding risk. This philosophy of extreme risk avoidance is the core of a book called Margin of Safety by billionaire investor Seth Klarman. It is a cult classic text that has been out of print for years. If you want a physical copy today, you have to scour the internet and pay thousands of dollars for it. We are going to bypass that paywall. We'll break down Klarman's defensive masterpiece into 5 practical rules you can use to protect your wealth from a financial system deliberately designed to make you gamble. To understand Klarman's strategy, we have to clearly define who we are dealing with. A speculator looks at a stock as a piece of paper to be traded. Their entire strategy relies on guessing what someone else will be willing to pay for that paper tomorrow. A value investor views a stock as fractional ownership of an actual business. They ignore the daily price ticker and analyze the underlying mathematical fundamentals, the cash flow, the assets, and the liabilities. Klarman illustrates this with a classic story from Monterey, California. The local sardines disappeared from their traditional waters, causing a massive shortage. Commodity traders jumped in, and the price of a can of sardines skyrocketed as they bought and sold to each other. Eventually, one buyer decided to treat himself. He opened an expensive can, ate the fish, and immediately got sick. He complained to the seller that the sardines were rotten. The seller replied, "You don't understand. Those are not eating sardines. They are trading sardines." Wall Street makes its money on transaction fees. The industry wants you to treat stocks like trading sardines. They prioritize the thrill of the casino over the boring reality of underlying business fundamentals, because high volume trading is what generates their profits. The financial industry promotes the idea that the daily price of a stock represents its true, rational value. Klarman rejects this. He adopts the concept of Mr. Market, a manic depressive partner whose daily price quotes are driven entirely by emotional mood swings, supply, and demand. Sometimes a price drop reflects reality. If a major hurricane causes billions of dollars in catastrophic damage, the stock price of Aetna Insurance will plunge. That is a logical reflection of real-world financial loss. But on a normal Tuesday, prices on the stock exchange still fluctuate wildly without any physical disasters taking place. Those movements are the result of collective panic or sudden greed from thousands of traders acting simultaneously. Looking to Mr. Market for guidance guarantees you will buy high when he is euphoric and sell low when he panics. The value investor's job is to sit back, let Mr. Market throw a tantrum, and quietly buy up the heavily discounted assets left in his wake. You might assume the smart money, institutional investors managing billion-dollar pension funds, are immune to this emotional trading. They aren't. They are trapped in a short-term performance derby. If they miss out on a hot trend, they lose their clients, so they buy fads just to blend in with the crowd. Look at the Winchester disk drive craze in the middle of 1983. Venture capital poured into the sector, and institutional investors aggressively bid up the shares of 12 different manufacturers to a combined market value of over $5 billion. A major academic study later analyzed the industry's actual math. It proved that the current and foreseeable fundamentals of those businesses could never have justified a $5 billion price tag. The herd was entirely delusional. Seeking safety by copying the consensus of institutional investors is an illusion. Acting with the crowd ensures an acceptable mediocrity in the short term, but guarantees substantial economic loss when the bubble inevitably bursts. Because human beings make analytical errors, and because macroeconomic conditions are impossible to predict, you need a defense mechanism. You must only purchase an asset when its price sits at a severe, undeniable discount to its mathematical value. Klarman uses a simple engineering analogy. When you build a bridge, you insist it has the structural capacity to carry 30,000 pounds, but you only allow 10,000-pound trucks to drive across it. That massive gap in tolerance is your margin of safety. In late 1987, you could buy shares of the Erie-Lackawanna Railway Company for around $110 apiece, but an analysis of the company's books showed it was sitting on nearly $140 per share in pure cash. Investors were able to buy a dollar's worth of value for 50 cents. Even if their analysis was slightly off, or the broader market crashed the next day, the sheer size of the discount acted as a mathematical shield against failure. Value investors ignore macroeconomic guesswork entirely. They use a bottom-up approach, sifting through thousands of individual securities one by one to find specific mathematical bargains. Once they find a discount, they look for a catalyst. A catalyst is a specific upcoming corporate event, like a liquidation or a spin-off, that will directly force the market to recognize the company's true underlying value and pay out the shareholders. This is why value investors spend their time digging through the ugliest corners of the market, analyzing bankruptcies and distressed debt. When the institutional herd panics and dumps an asset, they leave behind heavily discounted cash hidden beneath the wreckage. Finding a catalyst removes the dependence on market sentiment. You aren't waiting for Mr. Market to wake up in a good mood. The corporate event itself realizes the value, regardless of what the broader stock market is doing. Klarman's method requires strict discipline. Buy fractional ownership in real businesses. Exploit the manic depression of the market. Ignore the herd mentality of the smart money. Build a 30,000-pound bridge for a 10,000-pound truck, and actively hunt for catalysts. Adopting this philosophy shifts how you experience the market. The anxiety of guessing daily price movements gives way to a calm, disciplined practice of extreme patience. You can let hundreds of pitches go by until you see the perfect setup. You stop fearing market crashes entirely. When prices plummet, you recognize it for what it is, a rare opportunity to buy assets for pennies on the dollar while everyone else is panicking. Take a hard look at your own portfolio today. Are you holding real, cash-flowing businesses, or are your shelves fully stocked with trading sardines? Let us know in the comments below, and tell us which finance or investing book we should summarize next. If you liked this video, please like, share, and subscribe to the channel for more.